Hi there folks, it's James Marley here, co-founder at Livewire Markets, and welcome to this one-on-one interview. I'm joined today by Morry Waked, Managing Director of Vinva. Now Vinva is one of the under-the-radar stories of the Australian market. It only caught my attention in 2023 when Morry was inducted into the Australian Fund Managers Hall of Fame, a great achievement. The firm was established in 2010 and today manages over $24 billion of funds under management, an impressive total. Morry, welcome to the studio. Great to catch up.
Thanks, James. Thanks for having me.
We're going to talk about how you invest and what's different and unique about Vinva. But for people that aren't familiar with the firm, maybe give us the quick elevator pitch.
Yeah, so as you alluded to, Vinva's been around since 2010. So 15 years so far. We manage around $24 billion in assets under management. But if you look at our organisation, the genesis of the core part of the team dates back to around 1997. So really, we've got almost 3 decades of history amongst the team. Many of us used to work at a firm called DGI, which was the largest investment manager in the world. I ran the global equity business for that firm, and then set up Vinva with my colleagues in 2010. So we're quite an experienced team with a long track record.
What's different about systematic investing? Explain to people what it is and how it's different from the fundamental investors that we often speak to here at Livewire.
Yeah, well, first and foremost, systematic investing is really another form of active management. At the end of the day, we are trying to do what every other active manager is trying to do, which is trying to outperform our benchmarks for our clients and add value to their portfolios. So sometimes there's a bit of a mystique and people think it's a bit more, some sort of black box or anything, things like that. From our perspective, it's really a glass box. What we're really trying to do is identify a range of different opportunities that we think we can exploit in the marketplace, because on average markets are not efficient, but try and implement those ideas in a very systematic and unemotional way. On average, we believe emotion detracts from performance. People, when they're emotional and things aren't going their way, they typically panic and sell. When things are going their way, they typically buy more. And there are some merits in doing that, but sometimes being a little bit contrarian and being going the other way is very beneficial. So from our perspective, a systematic approach is really about discipline, a process that's repeatable, and importantly, sticking to what your insights say you should be doing and removing emotion out of the process.
And are the inputs to your process similar to the sorts of inputs that other active managers would be looking at? Earnings, price ratios, all that sort of stuff?
Yeah, to a certain degree, absolutely. There's no one right way to pick stocks. There's a range of different pieces of information and the like that drive share prices. Some will drive share prices over what I'd call a more shorter term period, and some will drive share prices over the longer term period. So really our approach is about getting the best of all worlds. So if you were to drill down and go through what we look at to differentiate companies around the world, everything that we talk about should make sense. Everything that we do as an organisation is grounded in sensibility. So yes, you mentioned earnings. Absolutely, a core part of what we do, a foundational part of our investment process is really anchored in fundamentals. Understanding, the company balance sheet, the strength of that balance sheet, understanding their accounting practices, understanding their cash flow, their earnings. And then we'll move into sort of some of the non-fundamental elements, understanding some sentiment indicators, some of the trends that may exist, some of the trading patterns, some of the behavioural biases that exhibit themselves. And we try and put that all together in an investment process. But generally, anything that we speak to our clients about should make sense, because everything that we're doing is grounded in sensibility, and that's the most important aspect of what we do.
And does Vinva have a style? We often hear managers talking about themselves being growth or value, momentum, GARP, these types of things. Is there a style that is appropriate for Vinva?
With respect to that, we've always defined ourselves as a style-neutral manager. Yeah. So we're not really biased to one style or another, based on the definitions that you're using. People typically refer to the main styles being value and growth as an example, and that's really a nebulous concept because it's really a continuum. Yeah. But from our perspective, being style neutral is really about creating an active strategy that can outperform irrespective of the market cycle that we're in. Whether it's a growth cycle, a value cycle, large cap, small cap, we should be equally likely to be able to outperform in all that. And that's really gets back to what I said a moment ago, that we're trying to capture the best of all worlds and put them all together in a single investment process.
What are some examples of the types of signals that you think are meaningful and that are valuable in your process when it comes to finding stocks?
Yeah, I alluded to some of those a bit earlier on. So at the end of the day, if you look at our investment process and the insights that drive our stock selection return forecasts across a range of different sort of investment themes, I mentioned before, fundamentals. So an anchor to what we do is really around fundamentals. So we look at cash flow, we look at earnings, not simple metrics like price to earnings ratios, but those sorts of things. We look at certain breakup of the balance sheet. We look at certain things that sit on the balance sheet and some changes and trends in those. So typically things that wouldn't be a surprise to a good fundamental analyst. We do the same. The difference between us and a fundamental analyst is that we're doing it across thousands of companies systematically every day. We also look at some behavioural aspects. As I mentioned before, there are some, one thing that doesn't change in investment markets over time is human behaviour. I'm sure you can reflect on yourself and your own emotions if you do invest, and our viewers out there, we do go through an emotional roller coaster as investors sometimes. And so there are predictable patterns around investor behaviour that we try and exploit as well. And also there are a lot of sentiment driven factors that drive share prices in the short to medium term. So we pick them up through some of our language processing models. We can read a large number of texts that are published either by the companies, analysts, news articles, and we process that information to try and garner some idea of what the sentiment is for a stock. So it's really a combination of all those sorts of things that allow us to come up with return forecasts and stock ranking models for companies all around the world.
Morry, could you give me a little bit of an insight into the technology that sits behind Vinva? You've referenced it there a few times about the ability to process data. What does the tech look like?
Yeah, so we brought it along the slide today, and hopefully the viewers can see that on the screen. But there's so much information in investment markets. There's over a 24-hour period, we're doing over 200 hours of processing of data every day. You can see from the slide up on the screen that we're analysing over 3 million news articles a year. We're analysing over 50,000 financial statements per year. We cover over 15,000 companies, and we've identified over 12 million linkages across those companies. I can give you some examples and touch on that a little bit later. So it is very technology and data driven. Technology and data does not come up with the investment ideas. That just gives you the platform by which you can implement those ideas and the data that allows you to implement your investment insights and take advantage of opportunities in the marketplace. So it's very data intensive.
And how does that process cater for periods like now where there are big shifts in sentiment and quite a lot of news in the market and quite a lot of policy uncertainty as well?
Yeah, there's so much information being disseminated always in investment markets, in particular over the past few months with the Trump tariffs on, off, and changes and uncertainty around that. That's really nothing new in terms of that sort of stuff. I think the topic of tariffs is something new on the agenda at the moment. But what's important is to know what you don't know. And you mentioned before, there's a lot of shifts in sentiment and so forth. And a lot of what drives share prices in the short term is noise. We have this metric that we refer to as a signal to noise ratio. The signal to noise ratio in stock selection markets is very, very low. So you really need to disentangle what's true information that you can use and process to forecast stock returns and what's noise. So what we do in an environment like this is ensure that we're focusing on what we know and also being aware of what we don't know. So we're not trying to make big calls where the tariffs are going to end up. We're not making big macro calls. We're really focused on the pure stock selection element of picking stocks within country, within industries around the world, and from an Australian equity perspective, picking stocks within industry to try and sort of, as best as possible, hedge out the things that we don't have a really good handle on.
So for our viewers out there that might be looking at their portfolios or whatever it is and diligently working away, what's an example of some noise that they should put to one side, save them a bit of time?
Yeah, look, I mean, at the end of the day, it's very important to, as one of the reasons why we are a systematic and disciplined investment manager is we want to try and take as much emotion out of the process as possible. I think good investors will have a list of criteria that they want to abide by, a philosophy that they want to invest by, and it's important to stick to that. So for the viewers out there, when the markets sell off after Liberation Day and there might be a bit of panic, typically, they're the times where you don't want to have a knee-jerk reaction. You don't want to panic and sell because the markets have sold off, or you don't want to doubt yourself and make decisions that may turn out to be the wrong decision. If you've got a process and a philosophy and something that you've researched and embedded in your portfolio, you want to stick with it. Equity markets are volatile by nature. They'll have their ups and they'll have their downs, but if you stay, on average, remain invested in the markets, you'll earn greater rewards than trying to time the market. That's our approach, and that's what history has told us over many, many decades.
Can you give us an example of how the team identifies opportunities?
Yeah, I brought another slide with me today that we'll put up on the screen for our viewers. I mentioned before that the global nature of our investment process and how we cover thousands of companies around the world. And what we're trying to do in that part of the process is try and measure or understand the interconnectedness of these companies around the world. So if I give you a simple example, up on the screen you'll see this web chart of circles of green and red. Up the top you'll have Apple. On the side to the right there's Nvidia, and at the bottom there's Microsoft. What we're trying to do here is look at those three companies and look at how they may be connected either directly or indirectly. And you'll see there's a line that connects Nvidia to Microsoft, that light green line. That's really saying that they have a direct connection. Microsoft is one of the biggest buyer of Nvidia GPUs. For example, in 2024, Microsoft purchased about 500,000 of Nvidia's GPUs, and more than Meta, which was second, and I think more than double what Meta purchased in Google. So it's a dominant customer for Nvidia. So understanding Microsoft and how its business is going and their demands and their growth, for example, will give us a bit of insight into what implications that has for Nvidia and their ability to sell GPUs to Microsoft. There's a whole cluster of companies in the middle between those three, companies like Trend Micro, Taiwan Semiconductor, and others. They're companies that are linked either suppliers or customers directly or indirectly to those Microsoft, Nvidia, and Apple. So understanding how their business is going will give us some insight into what implications that will have for Apple or Microsoft and so forth. Now, if you take those three stocks and visually sort of map that out across 15,000 companies around the world, and look at things not just beyond customer and supply linkages, but to some other linkages that might be less obvious, more subtle linkages, we can build a global sort of map of how stocks around the world are interconnected, either at the first layer, second layer. And so if something happens to a stock in Europe, we can see the impact that announcement or that sort of trend for that company has on other stocks around the world. So trying to give you a simple example of how we link stocks around the world and use that to come up with better return forecasts and differentiate companies around the world.
Quick question, how many stocks in a typical Vinva portfolio? We hear arguments, the case for concentration.
Yeah.
We've also hear the case for diversification. I imagine you've spent some time trying to optimise the number of stocks in a portfolio.
Yeah.
What have you come up with?
Yeah, so we sit in the latter camp. We're certainly more around the diversified, holding a diversified portfolio. So if you take an Australian equity strategy of ours, an active Australian equity strategy, a long-only one, we'd be typically owning over 90 to 100 stocks in that portfolio. You take our global equity strategy, we're owning north of 400 stocks in that portfolio. So it's really about a diversified portfolio from our perspective. We're trying to capture a lot of small opportunities consistently every day, every week, every month. So, one is when you're invested in equity markets, you want to capture what we call the equity risk premium, right? You invest in equity markets because you believe on average, equities are going to outperform cash. And that's called the equity risk premium. So that's number one. And then on top of that, you want to add some outperformance or alpha, or active return above the equity risk premium. And to do that, you need to make some active decisions. So diversification allows you to capture that equity risk premium, but then taking over and underweight positions allows you to capture that outperformance and add value above the equity risk premium. That's how we think about it, and so forth.
And what about the role of macro and bigger picture, themes or inputs for stocks? We hear a lot of people forecasting what's going to happen with interest rates, what's going to happen with economic growth, etc. Do those go into the models?
Yeah, so we absolutely take into account the interest rate environment. We take into account macro trends. We're dealing for our global equity portfolios in 48 countries around the world. So understanding the economic cycles that each of those countries are in, and some of them are in sync, some of them are out of sync, is an important component. But typically, we take the macro information and we translate that into the micro. So we're not using macro information to make large country or industry bets and taking macro positions in the portfolio. We're typically taking macro information saying, okay, if economies are going this way, if GDP growth is above expectation or growing strong or slow, or interest rates are rising or falling, what implications does that have for the companies that are exposed to those economies or more exposed to interest rates? And how does that filter into the industry that they're in and help us make better stock selection decisions? So the macro really feeds into the micro is how we look at it in our portfolio. When
it comes to picking markets to invest in, what work have you done to find out where the best opportunity to generate alpha is? Because I imagine there's been a systematic approach to that as well.
Yeah, so really there's opportunities all around the world. It's not like there's only outperformance or active opportunities in mid caps and small caps or emerging markets, which typically people think are less efficient. And on the surface they are. Take, for example, emerging markets, they are less efficient. But also there's a bit more geopolitical risk. The trading costs to implement and buy and sell in those markets are higher as well. So you need to take that into account as well. So we look at opportunities, we find opportunities all around the world, even US large cap, so which are arguably the most efficient equity market in the world. There are still opportunities to generate alpha or outperformance. So we really have a broad-based, diversified approach to stock selection, and we're finding opportunities across the globe in all countries around the world and also in all segments around the world, whether it be large cap, small cap, mid cap, emerging markets, developed markets and so forth.
Yep. Morry, final question. You've been implementing this systematic approach for, I guess, 3 decades now.
Yep.
What's the main takeaway that you've picked up that most investors might not be across, given that background you've got?
Yeah, I think for any good investment manager, whether they're systematic or otherwise, to be successful and to deliver consistent outperformance over a long period of time, you need to have a philosophy and an approach that stands the test of time. So if you think about our investment philosophy, which is really based on what we call the fundamental law of active management, which is really about delivering high risk-adjusted outperformance to our clients. And to do that is a function of 3 things. One is skill, your ability to forecast stock returns and differentiate future winners from future losers. 2 is having a high breadth strategy that allows you to implement your ideas across many stocks and many markets around the world. And the 3rd component is really about efficiency. How do you translate stock ranking models into portfolio holdings? That philosophy is the philosophy that we've abided by for over 30 years. That hasn't changed. What has changed is the data and the technology and the types of information that you can capture. If you look at the investment process and what we're using to rank stocks today, and you compare it to what we were using in 2010 or 2020, there's very little overlap. It's really about continuous innovation, and what's really changed is the data that's available, the information that you can have access to, and also the competitive landscape. So you just have to keep moving forward and innovating. That's been the big change, but that's also what keeps us excited. That's what keeps us motivated, and that's what we love about this industry, because it's very dynamic and no 2 days are the same.
Well, Morry, thanks for coming in. Great to catch up.
My pleasure. Thanks for having us.
Ladies and gentlemen, I hope you enjoyed that interview with Morry Waked, Managing Director at Vinva. Remember, if you enjoyed this interview, check out our YouTube channel. We've got plenty more content just like this.